On September 1998, a hedge fund managed by Nobel laureates stared into the abyss, nearly dragging Wall Street with it. Long-term capital management, or LTCM, started as the epitome of financial brilliance. Founded in 1994 by John Meriwether, a former Salomon Brothers trader, it boasted a dream team of financial experts, including Nobel laureates Myron, Scholes, and Robert C. Merton. These men were not just academic figures. They were titans in the world of finance, celebrated for their pioneering work in options pricing theory. Their sophisticated models promised incredible returns, and for a time, they delivered. In its first 10 months, LTCM achieved a stunning 20% return, followed by an astonishing 43% in 1995. By the end of 1996, the fund managed over $140 billion in assets, a testament to the faith the financial world had placed in its strategy. The fund was hailed as a marvel of modern finance, a beacon of what could be achieved with the right mix of intelligence and capital. But beneath the surface, danger brewed. LTCM's aggressive leverage strategy was a ticking time bomb. By 1998, the fund's leverage ratio ballooned to 25:1, meaning for every dollar of its own, LTCM borrowed $25. This massive leverage amplified potential gains, but it also magnified potential losses. The genius models that promised security were blind to the storm brewing. August 1998 was the tipping point. The Russian financial crisis hit as Russia defaulted on its debt, triggering market volatility that LTCM's models hadn't accounted for. Suddenly, the trades that once seemed infallible turned toxic. The ripple effects of Russia's default spread like wildfire, causing a global flight to quality. Investors rushed to sell risky assets and buy safe ones. As financial markets reeled, LTCM's positions crumbled. The fund had placed vast bets on bonds and derivatives, expecting spreads to converge based on historical data. However, the opposite occurred. Spreads widened dramatically as fear gripped the markets. In a matter of weeks, LTCM's capital vanished. Approximately $4.6 billion was lost, creating a liquidity crisis. The implications of LTCM's potential collapse were terrifying. The fund had intertwined itself with nearly every major financial institution, creating a web of interdependencies that threatened to unravel the global financial system. The scale of potential failure posed a systemic risk to the entire financial system. The Federal Reserve, fearing widespread economic damage, took an unprecedented step. On September 23, 1998, the New York Fed convened a meeting with the heads of the major Wall Street banks. The room was filled with tension and urgency as the Fed made its case. LTCM's collapse could trigger a chain reaction, threatening the stability of global markets. After intense negotiations, a consortium of 14 banks, including titans like Goldman Sachs, Merrill Lynch, and J.P. Morgan, agreed to inject $3.6 billion into LTCM to stabilize it. This intervention was unprecedented, highlighting the gravity of the situation. The bailout was not just a rescue. It was a lifeline to the entire financial system, a desperate attempt to stave off disaster. The fund was ultimately liquidated in early 2000, marking the end of a financial saga. As the dust settled, the financial world was left reeling from the close call. The lessons from LTCM's collapse are etched into Wall Street's collective memory. It showcased the fragility of the financial system, the peril of over-reliance on mathematical models, and the inherent risks of high leverage. Even the brightest minds can falter, blinded by their own brilliance. The arrogance that came with their success created a blind spot, a belief that their models were infallible. But the markets, ever unpredictable, proved otherwise. As LTCM's story faded, the financial world was left to ponder the true cost of unchecked ambition. The events surrounding LTCM served as a harbinger for future financial crises, a stark reminder of the dangers lurking in the shadows of high finance. The fund's collapse prompted calls for greater oversight and regulation, especially concerning hedge funds and their use of leverage. It was a wake-up call, yet, as history would later show in the financial crisis of 2008, the lessons were not fully heeded. The emotional toll on those involved with LTCM was profound. For the once revered Nobel laureates and financial wizards, it was a humbling experience. The collapse shattered their reputations, casting long shadows over their illustrious careers. The very models they had built their careers on were now seen as flawed, their assumptions questioned. For John Meriwether, it was a personal and professional defeat. The weight of the fund's failure was heavy, a stark contrast to the optimism and confidence that had characterized LTCM's early days. The investors, too, faced significant losses. Many had placed their trust and substantial sums of money into LTCM, only to see their investments evaporate. The sense of betrayal and disillusionment was palpable. For the financial institutions that had bailed out LTCM, it was a costly lesson in the importance of due diligence and risk management. They had stepped in not out of altruism, but out of necessity, to protect their own interests and the broader financial system. In retrospect, LTCM's rise and fall is a cautionary tale about the dangers of hubris and the limits of mathematical models in predicting market behavior. It serves as a stark reminder that in the world of finance there are no certainties, only probabilities. The story of LTCM is a testament to the complexity and interconnectedness of global markets and the delicate balance that sustains them. As the financial world moves forward, the echoes of LTCM linger, a reminder of the thin line between genius and folly in the world of high finance.